Hello, everyone, and welcome. So this is the first ever webinar that we've done here with Core Connect. So we hope you all enjoy it, and we will be sending out a survey afterwards to get your feedback to make sure that we're always improving and getting better each time. My name is Emily Cornelius. I am the Director of Marketing here with Core Connects. And very appropriately, with my role, the first topic here we have is marketing your raise from traditional capital raises to digital securities, strategies and considerations. So we have two fantastic speakers here with us today. We have Andrew Korn and we have Rick Tapia. I'll let them introduce themselves, but they have a lot of experience across digital securities and as well as traditional capital raise. So I think it'll be a great cross-section and great conversation today. So I will pass it over. Rick, do you want to start? Just introduce yourself and a bit about you.
Yeah, absolutely. Thank you so much for the introduction. My name is Rick Tapia, and I am the Chief Marketing Officer and Partner at Blockchain Agility. At Blockchain Agility, we really seek to help companies solve many of the complex problems they end up facing when conducting a digital security offering and advise them kind of on the path to success. These issues obviously can range from legal compliance to marketing, obviously, to talent sourcing and tech development, among others. So that's a little bit about us and myself in a nutshell.
And hi, I'm Andrew Korn. I'm the founder and CEO of E5A Integrated Marketing. We are a systematic, data-driven investor acquisition firm. What that means is we help funds of all structures and strategies raise money to manage, and we work with companies and projects kind of almost in all stages. Work to help them raise capital for their company or for their projects. And we tend to do that at scale, but also work institutionally.
Okay, great. So let's jump right in. The first question I wanted to ask you guys, it's sort of a three-parter. So I'll ask the question as a whole, and then if you guys want to break it down or each kind of talk about your different perspectives or different experiences. So how is marketing for an offering different from marketing in general? And what are some of the precautions you need to take marketing an offering specifically? And obviously what can happen if a company does not follow these regulated guidelines?
Andrew, I can start with you. It doesn't matter.
Go ahead, Rick.
Okay, so to answer kind of your first question about, how is marketing for an offering different than marketing in general? Marketing for an offering is different because of your audience and what your ask is. In an offering, many think that you can kind of take this shotgun type approach because you're only asking for funding, right? Well, on the other hand, your audience may actually need to be more targeted than just a traditional campaign, to really ensure that the right eyes are seeing your offering and that are really interested in that it really truly jives and connects with what they're looking to do, especially if you're looking at asking for investment dollars. So that's kind of my nutshell answer for the first one. Andy, do you have any thoughts?
Yeah, sure. So what happens a lot when we see people raising capital is they'll start with, hey, we already have a lot of customers, we have a lot of fans, we've got a social media following, and a couple of things are at play there. One of them, and the biggest one is that people think the people who love them and buy their products or services are going to immediately turn into investors. And that doesn't always happen. And there's a few reasons for it. One might be where they are in their life cycle. Are they really ready to invest in a company? So, if you were a music producer and your target audience is between 17 and 23, that may not be necessarily a high percentage of people who are willing to invest. Next is kind of the structure of what you're doing. So if you're doing a Reg D or a Reg A plus, and you're selling equity either in digital securities or in traditional securities, but there's no instant path to liquidity, then you're also asking people to put money and buy shares in something where they can't trade it very easily. Even with digital securities, there may not be a secondary market instantly. So now you've got a group of people who are younger and maybe a little less experienced, and they love your company and they love your product, but are they really ready to invest? And then invest, yet another hurdle is, oh, they're going to invest and there's not an immediate way out. So we start thinking a lot about what are they going to get for it, and how is that working for them. So sometimes you'll see perks, or there'll be a dividend, there'll be something, but essentially we're looking for what is it that we're marketing, not just that they love you. So we have had experience where, oh, well, we have a mailing list of 200,000. And we looked at the demographics of people who love them and said, gee, this is not what we would call a group of investors. So really deciding who you're going after is an enormous part, and the assumption that, oh, our fans love us, they're going to invest in the company, doesn't always hold true. And I can expand on that, or Emily, I'm not sure, how you want to handle this.
Yeah, I mean, we have some time if you want to jump into more, or if you want to get into maybe some specifics around, if there's any specific regulatory marketing tactics that need to be considered or followed specifically. I mean, I don't think you need to break it down by different offering types, but if there's anything sort of specific as a, first of the minefield that you would like to sort of share with everyone.
Well, Rick had brought up targeting, which I think is really important. So one of the first things that happens when we're working with an issuer, and full disclosure, Rick and I work together and also work with Core, which is a fabulous company, and why I think we both agreed to take time out of our day to jump on this webinar. Supporting Core is definitely a priority for my firm, and I'll let Rick speak for himself on that. Anyway, we ask issuers, who are you wanting to raise capital from? And if they say they're fans, I think we've covered that. If they say institutions, or they say we're going to go through financial advisors, or we want to go to family offices, or we want to find a whole new batch of people and we'd like them to become customers as well, each one of these changes the way we're going to approach it. The thing that always holds true is being compliant. And depending upon which jurisdiction you're in, say, we really want to expand into England when we're doing this, we're going to have all the rules that happen in England. If we're doing it in Canada, well, which province? It's not as simple as doing the entire country. And of course, if you're doing it in the United States, then you've got FINRA to deal with, or you've got the SEC at a minimum. So who is doing compliance and making sure that everything is reviewed and that, we're well within guidelines is a super important thing. So, one of the things of working with a firm that is used to those guidelines so that they're not caught in the trap of using words that are trigger words for the regulators, and staying away from things like that. So, making sure that you are compliant isn't as simple as, hey, we're ready, let's have the lawyers or a broker-dealer look at this and approve it. It's really starting way before that about what your approach is and how you're going to say things.
Yeah, and I would agree with that. And to kind of expand upon that, one of the questions I think you asked, Emily, was, what are some of the precautions you need to kind of take when marketing and offering? Well, there's plenty of examples out there, that show you how you should not market an offering. Obviously some of which that were fairly recent and really in the ICO and Regulation A+ world. And some of these precautions, are, don't promise outlandish returns on investment. Don't create this kind of false perception of what your platform or technology can do. Don't lie about partnerships or team members or anything like that. Don't spam your investors. There's plenty more precautions to take. And I understand that some of the ones that I just stated were kind of more common sense, but you know, one thing that we've seen in the marketing world today is that common sense isn't so common, especially to actually making sure you're saying things that are truthful. So that would be my answer for that.
Okay, great. So, okay, so we talked a lot there about the regulators and being, fully compliant in that. So let's just jump right into the big elephant in the room. Obviously, um, there is a lot of negative connotation around, tokenized securities, ICOs, sort of this whole sort of transitioning and evolution of taking securities online. How do you help your clients differentiate themselves from these negative connotations, or the, let's call it, the anti-regulation crowd, or the people who weren't necessarily compliant in their raise? How do you sort of differentiate and ensure that your clients are standing out as the ones who are following, the correct steps and moving forward in a compliant and regulated way?
Yeah, I'll go ahead and tackle this one first. It's kind of the golden question right now, right? While I believe the distinction will kind of fully manifest itself here in due time in separating, digital securities or smart securities from the world of, ICOs and cryptocurrencies, and like you said, the anti-regulation crowd. To people really kind of in the mainstream world right now, the two are still very much tied together and kind of convoluted. But steps are have to really be taken with issuers today, so that their investors and the respective market really kind of understands this difference. For what some of the things that Andy does and that we do, we really help in kind of crafting the messaging and branding that really kind of helps with this distinction, especially early on in the phase of the market that we're in. So for one example, an issuer may elect to refer to their digital securities as, kind of smart securities, and shy away from utilizing the word token or maybe tokenization, in kind of part of their branding and messaging. It's a very delicate process that I think kind of requires a lot of careful thought and time, especially in the phase of the market that we're in.
Right. So I'm going to tag on to that and basically say, myself and my firm worked on one ICO for a friend in Gibraltar, and it was for a very specific purpose, and the currency is there, and I think everyone is very happy with what they have, meaning it was structured well. But a ton of ICOs were basically an idea and a prayer, and many of them raised a lot of money. They didn't necessarily have everything in place to really make a run of it, and people were banking on essentially a supply-demand market to make that currency go up. It was the Wild West, and in general, we stayed away from it. What we're seeing now is a natural evolution. Essentially, when one buys a stock now with an online broker, they're buying an equity. They bought it on an open marketplace. They're able to sell it in an open marketplace. The amount of liquidity is based on supply and demand and whether people are interested or not interested in that issue. You'd be shocked, I think most people would be, how many securities that are listed on the New York Stock Exchange have zero volume in a given day. And the number is actually quite large. Same thing happens on the NASDAQ and the OTC as well in the US. And I believe there's plenty on the Canadian exchanges also that have very, very low volume on a typical day. So liquidity is really determined by that supply demand. With digital securities, what we're seeing now is, hey, we're going to be able to trade these on secondary exchanges. It's going to be a supply and demand. And what's the difference between that security and a regular equity? Well, the biggest difference is that it's digitized. So I own shares in companies like Apple and Netflix and Amazon. I don't actually physically take possession of those shares. I don't remember the last time I saw a stock certificate. So in a way, we're all participating currently in a digital marketplace. Taking that a whole step further and moving into the blockchain eliminates a lot of the middlemen that were involved and much freer and easier on these secondary markets to trade. And that will eventually bring a lot of liquidity when the market gains more traction. But what it has in common with Amazon and Netflix and all these other stocks is that these are FINRA approved in the US. They're FINRA approved offerings. They've gone through the SEC regulations. The filings are there. The security attorneys are there. And it's being done in a compliant manner, which is why the marketing has to fit that compliance as well. So it is my belief that this will eventually turn into the largest market for equities in the world, and that it won't need a single jurisdiction in which to trade, although it will have to follow the laws within each of those jurisdictions. So, to me, the difference between a cryptocurrency and an ICO and what we're talking about today with essentially regulated digital security offerings is a night and day difference. But they're both on the blockchain, and there's a bunch of things that have overlap there. So an education process is required to let serious investors know that, hey, you're in a regulated world here. It's safe to put your toe in the water. There aren't as many, quote, fly-by-night or profiteering people within this industry. Now, you can say that there are, in the way that there are plenty of companies out there that end up being scandalous, but the way they brought their securities offerings to market was done in a compliant way. So, essentially your diligence has to go from, wow, will anyone ever be interested in this currency other than me, to, hey, this is a regulated offering now. And now my diligence is am I interested in owning a piece of this company? The same way you would with a general stock offering. So to me, it's a night and day difference. And the thing that we need to do as an industry is educate people that this is what they're buying. And with the offering being very clear of what's being offered. Is it debt? Is it equity? Is it a combination? And making sure that that's communicated, and of course, in a highly regulated manner.
So do you find you're spending sort of just as much time marketing, the company, the opportunity, the forecast, the marketplace, all that, as you are marketing how it's regulated, how it's fully compliant, and like you mentioned, the whole opportunity for liquidity in secondary markets? Like, do you find it's with digital security specifically, you have to spend just as much time marketing that side as you do the actual business opportunity side?
Rick, do you mind if I jump in on this?
Yeah, absolutely.
First, so, to use the baseball analogy, because it's almost spring, we're at the top of the first inning here. So it should be a 99-1, 99% about the company and 1% about the structure, and that it's a digital security, but we're not there yet. Society needs to catch up to technology, because the technology there is there to do this through the blockchain. Is everyone really ready for it yet? So right now, that ratio is much higher of having to explain what a digitized and what a digital security is. And that will reduce over time as it becomes more accepted. And, the general investing public realizes that, oh, this is what I'm doing. And that this is, in my opinion, much more of an evolution than a revolution. The revolution is, hey, we don't need all these things that we used to need, yet, FINRA may impose some of them for a while and then loosen those reins so that we can truly leverage the blockchain. So yes, right now it's probably 80-20. And, I counsel companies not to protest too much, meaning don't lead with, let's explain to you what this digital security is. Lead with the story, lead with your financials, lead with your where are you going in the marketplace and why you're critical to the world and why you're going to be successful. But then you do need to explain the structure, why it's different, that it's regulated, and why they should be comfortable with it.
Yeah, and I think to piggyback off of that, we've seen, issuers on our end, at least early on, kind of offer this dual option to investors, where on one hand you do have the option to buy a digital security and get all the benefits that kind of come along with it at this point, or offer just a traditional paper stock certificate type security and conduct it in that way. And what we've seen is that an appetite for an investor, when they kind of have both options presented to them, it's a lot more appealing, especially for ones that maybe have maybe to little to no really working knowledge or understanding of blockchain or anything like that. So that's something that I would add to that.
Okay, great. So let's sort of veer into more specifics on actual tactics. So the next thing I want to talk about is, what role does the media play, if any, sort of pre, during, and post fundraising with digital securities?
Andy, do you want to go and start on that one?
Sure. So, there's a bunch of types of media, depending upon who the issuer is. There might be trade press, then there's going to be the consumer press, and then, of course, there's the financial press. So essentially, once you are issuing securities, you are also in an investor relations world as well. And there's a fabulous organization called the National Investor Relations Institute, known as NIRI, that has all sorts of guidelines and support for newly minted investor relations people. So the press is a huge portion of it because, media is broken into owned media, meaning what you produce, purchased media like buying, advertising, and direct marketing, and shared media, which is social media, and then earned media, which is the press. So certainly getting a feature story in a publication like Barron's or in a major national newspaper like the Wall Street Journal can really have a super positive effect on your offering. But is it compliant? What did you say? Was it the right time? Anyway, so that type of thing can be literally life-changing for a company getting the right placement. But how does that start and how do you get them interested is an entire industry within investor relations and public relations. So the role of the media is super important, and sometimes starting in lesser known publications and blogs and influencers is what's going to drive the national media. But also depending upon the issuer and what they're doing, maybe they don't want national media, maybe they want regional media or they want niche media. So a lot of things come back to strategy and planning. What do you want? How do you want that to happen? How does that contribute? Kind of getting into the specific tactics, if you're not raising money from your fans and your clients and your typical customers, are you raising money from people who have never heard of you before? How many times do they need to hear of you before they're interested and they're willing to even look? How many times do they need to hear of you where they're not only interested in look, but are willing to do diligence, meaning look in and make a serious decision, yes or no on investing? And then how many times do they need to hear of you before they will ACH the money over or write a check or a wire or whatever it is they're going to do? So the media has a critical role in all of this, as well as social media can have a big role in this, again, depending upon who the followers are and are they the target audience for the offering as opposed to the target audience for the product, which, as we've talked about, may or may not be the same group.
Yeah, I would absolutely agree with really a lot of what Andy is saying here, especially, during your pre-phase and during the actual phase of your offering, and you're talking about the post-offering phase. Media can have an exponential effect, and if it's after, your raise is finished and they're talking about, in the media exactly, what you guys raised and some of the things you're doing with your platform and things like that, whether that's through earned in this case. There's a lot of positives that can come from it. So, to answer it simply, it plays a very vital role in all three phases. But to Andy's point, it really kind of comes down to what's being said and to what audience it's being said to.
So when you guys are pitching the media, sort of earned media, are you pitching, so going back to your point, Andrew, how there's sort of different channels within the earned media, are you pitching to, say, a technology journalist and talking about the digital security side of the story? Are you pitching, the financial journalist about the opportunity, the business role? Like, how are you piecing the whole story of, the business and the opportunity with the blockchain sort of aspect of the digital securities? Or are you not? I know you mentioned before it's about 80-20. Are you, when you're pitching media specifically, do you involve that aspect of the story?
I'd love for Rick to answer this first before I do, if Rick is up for that.
Yeah. I mean, it's interesting. So it depends really on kind of the publication and really kind of what we understand their audience is going to be. We've in the past, when we've worked with some blockchain, and cryptocurrency based clients, and they're talking to kind of a blockchain based organization, a media publication company, the conversation in terms of what the technology platform is able to do and some of the inner workings that we understand that they'll understand along with their audience, that definitely is able to kind of open up what our abilities are to really kind of discuss some of the benefits of what the technology does and things of that nature. But when it's kind of been more crossed into the world of more of a traditional media outlet that, maybe has kind of a surface level understanding along with their audience, kind of curtailing what that message is based off what their working knowledge would be and what we anticipate their audience to understand, can play a role.
All right, so I agree with Rick on that, and just to kind of add on to it, so my firm does not pitch the media. We're not a PR firm. We focus much more on paid media, yet we do very much work on the strategy for earned and also shared media. So working on those strategies and making sure that the messaging is consistent and that the publications being targeted can do one of two things, and is the criteria. First is, of course, acquiring new investors. The second is earning credibility. So if our client is in the technology world and being in a technology publication and being able to add that article to what we're doing will provide more credibility, even though their audience isn't necessarily investors, then that's a very worthwhile placement for the PR firm to get done. The world is sometimes bigger than that super focused audience that we're looking at as the investors, because for them to make their allocating decision, yes, we'll invest, credibility needs to be there as well, and the press in those publications can be a really good way of doing it. So when dealing with digital securities, and we need to look for early adopters in digital securities as well. So to Rick's point of going after publications that focus on blockchain, where this is something already accepted as being everyday, is definitely a great add-on. But being in the major financial press, getting an appearance on CNBC, there's very few things that can replicate that. And then the question is how much time do you have and how many messages can you get across, and what's the order of priority in this? So all of those things need to work together in concert to really fulfill the offering, in a timely manner and on budget.
Right. So, okay, so we talked a bit about sort of earned media there, and you started getting into other channels, Andrew. But let's talk about, are there any unique channels that you use for marketing your digital securities? So whether it's, I mean, we talked about earned, but let's talk about some owned and paid. Is there any sort of unique channels that everyday marketing wouldn't necessarily touch on or anything? And then how do they all sort of work in unison to market the offering?
So I'd say no, that at least my firm's not using channels that are not used by sophisticated marketers everywhere. And I think that you hit on it with how do they work in concert. So one of the things, and you brought this up earlier, is what's the difference between what we're doing and general marketing. So what we're doing is a lot like a product launch where traction for that new product needs to be achieved. So let's say we determine through some testing that it takes 12 touch points for someone to make a investing decision for this particular company. Well, how are we going to get those 12 touch points? Are they going to see it on Instagram, or are they going to see it in a tweet, or are they going to see a paid ad? Are they going to read about it in a publication? What is possible? What's the time frame we can get that done in? Because if you're using the exemption, let's say through Reg A plus, you have a little less than a year to get it all done. And of course, I say a year, there's probably sighs all over the other end of the phones of, we can't take a year to do that, which everyone is acutely aware of. So what's the time frame that we're doing this in? You have a year legally, but you want to get it done in 3 months or 4 months or 2 months or 6 months. So how many touch points and what amount of time, and what are those costs? Getting into a major publication, you're not paying for all those impressions, but you certainly paid something to get yourself to the point where you were able to earn that media that you just earned. So figuring that out and how that works in concert is key to the strategy when you're first starting. And then optimization of that as you are doing your offering is even more critical, so that you're able to pivot very quickly to where the investors are and where you're getting traction, but making sure that you have not only the right reach and targeting, but the right frequency. Because if it takes those 12 touches, it takes a lot to hit an individual person and making sure that they're getting the right messaging 12 times. So that just make it more complicated, or did I answer?
Yeah, absolutely. And well, to add on to that, I think you kind of asked about, specific publications that, you might find, or channels that you kind of focus on. It's funny, I think with specific credits to digital securities, there's not a lot of specific publications that are going to just specifically be centered and focused around it. I mean, there's a couple of emerging ones that are out there, but a lot of them, because they're very much in the infancy stage, like a lot of the spaces in general, a lot of them don't have the reach or the audience yet to really make them kind of a marquee target for where you want to really market to. Now, could that change obviously in the next, in the next time frames of 6 months to a year? I'm sure, absolutely. But you obviously still have blockchain and cryptocurrency based outlets that obviously have familiarity, and their readers are very much have an appetite for it. In the traditional sense, there are publications like Forbes that, in the past, that have published, blockchain and ICO related stories, and different stories now about digital securities. And you can consider them, I guess, more of a traditional outlet, but it's a very fine line, and a lot of these outlets are starting to kind of dabble in a tiny bit, but it's not quite ready where I think to where you have a really mass marketplace available to you for some of these different outlets.
Right. Okay. So that makes sense. And I think whether it's marketing and offering or whether it's marketing in general for a product or a business, you always need to make sure that those different channels and different channels as well as earned, paid, and owned media are all working together to tell the story as a whole. So, okay, sorry, we had a couple questions come in just while we were going through the first questions there. So I'm going to actually jump to some of those if you guys are okay with it. So the first question, if a company is looking to do a digital offering, and obviously, there's a lot of marketing involved with that, as we've been talking about, how much should they either set aside or anticipate spending budget-wise to market their raise specifically? So outside of their everyday marketing budget, how much should they anticipate spending when they're marketing their digital securities?
So I'll jump in on that first, and the answer to that is directly related to how much money they're raising, and then what audience they're going to raise it from. If they are an institutional raise, then they may be raising more money because institutions are used to writing much larger checks. And actually won't bother doing diligence for a small amount of money. They're not going to investigate a company unless they're writing a large check. And access to the data on them is actually way less expensive than going after consumers. I'm going to guess that the bulk of the listeners, though, are more in the consumer space. So the question starts with, who are this investor group going to be? How do we find them? Are they based on demographics and behavior, or are they based on where they go and what they read? And we usually start off with a test on both sides of that equation, on the paid side, and then look at the data to see where we should start allocating our dollars. So I know I haven't answered the question because you're looking for a numerical answer, but I just want to add the reason that most companies don't make it, and of course most companies don't, is because they're underfunded. And the reason most of these raises work, when they work, it's because they're well funded. So we say, depending upon what you're doing, it could be anywhere from $20,000 to $200,000 to get the raise to where it is self-funding. Meaning, we want to raise $15 million. It took $200,000 to get us to the first close, but we closed on over $2 million. It's going to cost several $100,000 more to raise the rest of the money, but that's coming out of proceeds. Meaning it's coming out of as we raise the money, and of course the paperwork has to be written like that. We've also seen it where it took very little money to get to that first close, and we're able to raise the rest of it, again, from proceeds. So it is a wide range there, literally a 10 times range I just gave. Rick may have a different perspective on it, but we always say, when you're looking to do this, it's not money of last resort. It is where you have the funding to be able to go out and do a marketing campaign that will be highly effective, like any other marketing campaign. Just the rules of the game are different because of regulation, and also the duration and budget is usually extraordinarily finite, meaning how much time you have to get it done, and that there's an exact amount of money, there's a budget that the client has, and there really isn't another dime behind that because it's not a big company that's doing it. So that has to be figured out on an individual basis. But again, the most successful ones are the ones that have the cash to have the power to get it done, the muscle to get it done. And again, I use that analogy. Most companies aren't successful because they're underfunded. And these campaigns that are not successful, the bulk of them that are not successful are because they're underfunded.
To really honestly, I would reflect a lot of what Andy is saying in terms of what, the pricing structure works and how you have a lot of different mitigating factors that kind of determined what your dollar spend is going to be and whether how much of that actually comes from initial funding versus what happens with proceeds. Um, Really, what we have seen is it does depend on how much you're raising. And again, to Andy's point, you may have an instance where, you may have to spend a little bit more than what you anticipated to get where you need to be. And other times you end up maybe spending less. And there's a lot of different factors that can affect that, whether it's timing, the current market conditions, the type of investors that you're seeking. There's a lot of different factors that kind of go into that formula. But I would reflect a lot of what Andy's points are in terms of what the pricing structure would kind of look like, because I think it's something that once you kind of really begin to understand the market, you realize that these companies and these investors are looking to really look for a certain type of offering, and that can really decide if they're going to invest or not.
Okay, so I mean, you guys talked about obviously there's so many different factors, and I think that's true for all types of marketing. You mentioned the amount of money companies are looking to raise will affect the cost. What about things like if a company's looking to raise in multiple jurisdictions and things like that? Does that also? I mean, I know it increases the resources internally needed because there's, the audience is varied and localization needs to be considered and things like that. But Do you think it increases the cost?
It definitely does. So it increases the cost from a legal standpoint. So the lawyers are going to get more money. You're going to need different paperwork for it. And then, it's not just jurisdictions, but are we doing things in different languages as well? And I always laugh because we do a lot of work in Australia as well as in the US. And we have a language barrier that people don't take seriously. But it needs to be taken seriously because there are a lot of expressions that are very different even between these two countries. And, we're aware of acting as local as humanly possible. So, we also may need to translate things. The other thing is that a website hosted in the US may not work for another country, and we may need to find hosting there. So there ends up being a lot of intricacies and other things that need to happen just to make sure that we're complying and not just being compliant to the letter of the law in the other jurisdiction, but being friendly compliant as well. And not just doing the bare minimum of what we have to do, but being a good citizen raising money within their jurisdiction.
Yeah, and to add on to that point, just beyond just the legal costs, you're going to have, obviously a local broker dealer that's going to be needed depending on what jurisdiction that you're in. So there's a lot of other kind of costs that come with stepping out into outside of like the U.S. or Canada, and it's interesting because one thing that, and again, I'm not an attorney, but one of the common misperceptions that we see in the space is, well, companies doing a Reg S, so now they can just raise, money from anyone in any country of the world. But, what people need to understand is that a lot of these jurisdictions, like such as in the UK and other countries, they have their own basically set of accredited investor type laws that need to be abided by whenever you're seeking out investment from their prospective citizens. So that obviously takes legal work, that takes diligence, that takes timing and working with broker dealers in that local jurisdiction. So, to answer your question, Emily, across really every channel, you can be looking at an increase in cost if you step outside of just your own prospective jurisdiction.
Okay, so I guess part two of that question. If a company did have a very, very limited marketing budget, so Andrew, I know you said that one of the more common reasons that these offerings fail is because of a limited budget. But if a company only had very, very limited marketing budget for their raise, what are the top maybe one or two strategies that you would highly recommend they put that limited budget or resources into if that was the situation?
Sure. So I'm only talking about marketing budget because, they made every I dotted and T crossed with the lawyers first.
Right.
So, the whole thing comes to reach and frequency, meaning how many people are they reaching? How many times are they going to reach them? And I would really make sure that there's a good balance on that you're not just casting this really wide net and hoping people will come, and that when they come, they'll invest. So going for the broadest audience isn't really the best strategy. It's going for an audience where you can reach them multiple times. And again, you can reach them different ways, not only paid media, but also earned and shared media. So understanding what you have and what your position in the marketplace is. We have a client right now that's got 10, 12,000 followers on different types of social media. We have another one with 1.4 million followers on social media. So that is dramatically different numbers, but is the 1.4 million, what percentage of them are really potential investors? And how many of them are following them on social media but will actually see it? So, the more you can figure these things out in advance, you're going to spend your money and invest your money in this, in this effort the most wisely.
Yeah, and I think to add on to that, I think one thing that I would also look at, especially in the realm of digital securities and digital security offerings for smart securities, it's really understanding what your investor composition looks like and how the structure of what your offering is and what your company is doing aligns with that. Because to be perfectly honest, we've seen thus far that there's very few industries and niches where there is an appetite with the prospective investor pool for digital securities. Now, I anticipate that changing here very, very soon to be able to expand out into many different industries and niches, but it's very segmented right now, and that's just a reality. But if you're able to work with a particular firm or company that can help you kind of craft that branding and messaging to where it does entice investors and they're not scared off by some of the negative connotations that unfortunately have come with blockchain and ICOs and things of that nature in the past couple of years, it can really go a long way in determining how successful you are, at least when it comes to a digital security offering.
All right, wonderful. So I'll just do one more question here, let everyone get back to their day. But the question came in about sort of ramping down marketing after a raise, or do you recommend ramping down marketing? I know, Andrew, earlier you talked about sort of getting into that investor relations sort of phase of things, but how, is it once a company has done their capital raise, then marketing sort of shuts down and moves into sort of the traditional everyday product marketing or business marketing. But sort of how do you recommend, I guess, that transition post raise, and does it ramp down? How does it ramp down? If you guys could talk to that.
So essentially, when you decided to do the raise, you've decided to take on partners in your business. So the question is that if you have partners in your business, how are you going to treat them? And how often are you going to communicate with them? And what are you going to tell them? So the role of managing those investors and investor relations, in my view, is really important. So having a plan for that in advance, I think, is critical. I ran a company where I had about 35 investors in my company, including several professional investors. And we decided to put together a board and have quarterly meetings. Well, that doesn't work if you have 5,000 investors or 2,000 investors. So what is your plan for regular, consistent communications? And how are you going to let them know how you're doing? So that's really different than the marketing that you did to raise the money, which is probably really different than the marketing you do to sell new customers on your product on a day-to-day basis. So again, planning is critical and executing is just as critical, and making sure that that consistency is there. Consistency helps breed confidence. Confidence helps keep investors happy, and happy investors usually breed more investors, which gets us back to that supply-demand thing that happens when a company has issued shares. So whether it's on a secondary market, on the blockchain with one of these alternative trading companies, or if you're issuing shares and going public the old-fashioned way on the NASDAQ or the New York or the OTC, whatever way you're doing it, you need a plan for how you're going to communicate, because you don't want people calling and asking questions that you could preempt. And of course, you don't want their lawyers calling. So,
Right.
Proper planning prevents poor performance.
Yeah, and I would agree with a lot of what Andy is saying here. It's funny. You can look to, I think, really in kind of a mini case study, a lot of what happened with these different ICOs that cropped up in the past, couple of years, and what you can see by examining their social media channels and their Telegram channels, you can really tell which projects really truly understood what it means to garner a community and to be able to cultivate it of investors and users, post revenue or post the sale being complete. Some of these projects literally went belly up. The communication completely stopped with any kind of investors. And now, obviously, in a more regulated sense, that can actually happen. But if you want to examine kind of the right way to do it and the wrong way to do it, I would examine maybe some of these companies just to be able to get a really surface level overview and be able to see it for yourself of which companies stayed in communication with their investors, communicated regular updates of platform development and things of that nature versus ones that didn't. And I think that'll provide kind of a good example, I think, of what type of approach maybe a company should really look at taking.
Perfect. All right. Well, thank you guys both so much. Anyone here listening, so if you have any more questions, either for me or for Rick or for Andy at all, I've got my email there on the screen. So please don't hesitate to reach out to me. I can make any appropriate introductions as necessary to Andy or Rick. But we have recorded this session, so we will post it up on our website and across our social, and I'll be sharing it with Rick and Andy if they want to send it out to anyone or anyone's asking. So if you want to rewatch it, you have that opportunity. And again, any questions or anything you have afterwards, feel free to reach out to me or reach out to us across social. And thank you guys very much. Rick, Andy, that was wonderful. A lot of great insights there. Next month, we'll be welcoming Darren Marble with our CEO, Oscar Joffrey, who will be talking about sort of the transition in the industry from the vernacular of, ICOs to STOs to digital securities, what it means, where people are using different terminology and all that. So stay tuned for information on that upcoming webinar. Andy, thank you. Rick, thank you. And everyone who jumped in to attend here, thank you very much. And hope you guys enjoy your day.
Thank you so much for having us.
Thank you.